Hey guys, Jack here. Today we're going to be covering my top 4 REITs for passive income. If you don't know what a REIT is, it's essentially a property company, and all the revenue it receives from rental income, it must give back to shareholders as dividend. As a law in the UK, 90% of the REIT's income profits must be given to shareholders. So it can be a great way of building passive income without actually investing large sums of money yourself in buying a single property. Obviously, none of this is financial advice, this is just my opinion. We mainly want to invest in REITs that specialize in a specific type of property that can give us good cash flow on a continual basis, but also has good stock appreciation. So the very first REIT we're going to be looking at today is Civitas Social Housing. This REIT provides a yield of around 4.82%, and it was one of the first REITs in the UK to actually specialize in providing social housing for England and Wales when it was first launched in 2016. It currently holds around 619 properties with around £803 million invested. The key thing about this REIT is that it doesn't do much development. It mainly just buys up existing properties. You're not going to have much development risk, whereby development that a REIT is doing gets put on hold and the REIT drops in value because shareholders lose confidence in that company. However, where there is risk, there is also reward. So this REIT doesn't actually have a upside when it comes to development projects. The more value you can add to a land or a bruised up property, the more appreciation you can receive. One of the key things about Civitas is that it specializes in having a social impact. They really care, or actually want to care, about how much the communities can actually benefit from their business activities. This obviously can be quite good for some people who want to invest in companies that, one, provide a good impact to the world, and also provide a good return. Their market cap stands at around 685 million, and with this the share price has been quite stable since the REIT's inception in 2016. I'll be honest, at first I thought social housing, residential, seems to be a lot riskier. Now, there definitely could be a lot of problems with rent collection, for example, and after doing some research, this company did end up proving me wrong. £46 million of rent was collected in 2020, up from the previous year, and unlike what I believed initially, 99% of rents were collected in 2020 despite whatever happened in that year. So they said they were pretty in line with their expectations. Now, with residential properties, there's definitely shorter agreements, so rent may be an issue when old tenants move out and new tenants are coming in. That period of empty space may be where income is not coming through. However, with commercial property, these agreements, leases, can be quite longer. Which brings me to the second REIT we're going to be talking about, which is Tritax Big Box. Now, before we move on to the next REIT, make sure you hit the like button and subscribe if you're learning something new. Now, this seems to be quite a popular REIT for UK investors. It's because mainly the industry it's in line to serve is growing quite rapidly. Now, it's actually given a 5-year appreciation of 37%, with the current dividend payment standing at 3.43%. Now, the unique thing about this REIT is that it primarily focuses on warehouse properties. Now, the clients that use these warehouse properties include M&S, Amazon, and other retailers who will operate online. I personally think there's huge potential in this REIT. We all know that the online world is booming quite rapidly, and this booming industry is not really here to stop. More and more high street shops are closing down and more of these brands are moving online. Tritax's biggest customer is Amazon, who has 30% of the online market share in the UK. These companies need warehouses to store products, to pack and fulfill orders. So with this in mind, I can definitely see Tritax's property portfolio is in a good position. As a company overall, the property that it holds is currently worth around £4.4 billion, and the share price is currently trading at £1.86 a share. Now, with the current information we have, it has around 59 development assets and with 30 million square foot of development land. Now, there was a bit of insider transactions or insider share dealing that went ahead. One of the partners of this REIT, James Dunlop, actually spent £270,000 acquiring shares of his own REIT. Now, he bought these shares at an average price of £1.70. Now, it's not only James, there's a ton of other insiders who bought up shares in this REIT, which gives me more confidence on the growth potential. This is because more than Yahoo Finance and Bloomberg, insiders have the most information about the company at the given time. Now the next REIT we're going to be talking about is Segro PLC. Now this REIT is one I've been talking about for a while on this channel. This REIT currently gives a dividend of 2.27%. Now it's currently trading around £9.60 a share, but if we look at the 5-year appreciation, it has given a return of 144%. Now like Tritax, it also operates in the warehouse space. In fact, it owns two types of properties mainly. One of these properties is what they like to call big box warehouses, and the second is urban warehouses. Big box warehouses are used for national and regional distribution centers, so getting goods from one part of the country to another. However, urban warehouses are more close to the city center. This is where there is a need for deliveries from the warehouse to the customer. So the likes of the big supermarkets are probably using the urban warehouses for deliveries, and large logistics and manufacturing companies are probably using the big box warehouses. Segro's business model is quite easy to follow and understand. They simply buy up land where they can actually add value. They don't seem to buy a property that's already built up. They want to buy land and buy broken up properties where they can actually fix them up or actually build upon, so they can actually get that appreciation up front. After adding value in either way, it either decides to keep that property and let it out to customers, or it just get rid of it, sell it straight away and keep a chunk of the profit. Now one thing to be considerate about is that when you invest in a REIT, your income, your dividend is directly related to the rental income the REIT is able to collect. Now Segro was actually in a position to collect 97% of its first quarter rents in 2021. This shows that they have good infrastructure and a sustainable business model. Besides, I don't really see a demand for warehouse properties falling anytime soon, so I think this will be a good REIT to watch out for or buy in the future. Now, if you don't want to invest in one particular REIT, you can also have an index fund approach about this, where you can invest in the iShares Property UK REITs. This is essentially a basket of all the top REITs in the UK by market cap. Now it's currently available on Freetrade, so make sure you sign up with my link in the description for a free share when depositing just £3 to the platform. Even if you buy this ETF, 18% of the weighing, 18% of each pound you put into this ETF is going straight to Segro PLC. Now in a normal case, ETFs are designed for diversification to lower your overall risk, but the way that REITs seem to be going at the moment in terms of office REITs, this can be a more risky approach. There definitely seems to be a bit more risk for shopping center and office REITs as more and more people are working from home. Now this can be a slight problem when you invest in this ETF because it has British Land as one of its top 10 holdings. Now British Land has seen a little bit of a drop in terms of its share price because it owns a lot of office spaces all around London. With that in mind, investing in an ETF like this can be a bit more risky than investing in a group of REITs that don't focus on the office space at all, because essentially you can just avoid office space REITs altogether. Now guys, if you're training to want to use up, make sure you check out my video here on the hidden truths of investment pies. Or if you're looking to build a dividend stock portfolio, then make sure you check out my video here on the top dividend stocks of 2021. Aside from that guys, thank you so much for watching. Make sure you hit the subscribe and the bell notification so you don't miss more videos like this, and I'll see you in the next video. Thank you so much for watching.